There's so much emotionally charged hype out there designed to sell newspapers and advertising rather than inform investors and traders. Want entertainment? Buy a newspaper or magazine or turn on the news. Want investment and trading concepts explained? Look to TechnoTrader. TechnoTrader is the gold standard in trading and investing education taught by experienced and accredited professionals. Don't learn to trade from fad-chasing day traders, and certainly don't think you can grow your portfolio by attending a weekend seminar or watching a free video online. Success in the financial markets is attainable, but like any high-paying profession, it requires the proper education to achieve consistent success. Join those happy few who've taken their investing and trading seriously. Call 888-846-5577 or visit technotrader.com.
Hi everyone. Today we're going to talk about how do you tell if the stock market has sufficient momentum to swing trade or day trade stocks. This is very important because, as I have taught you in the past, between 36 and 40% of all the daily activity, all the transactions, all the orders are off the exchanges. Since your charting software and your retail trading systems are tied to the exchanges, you don't always get all of the data or the information. You can look at stock charts, but it is very hard to tell sometimes whether there is sufficient energy, momentum, to move the stock up sufficiently to make very good point gains. When you're swing trading, you want to make at least a couple of points to 10 or 12 points in one run gain. That's what you're looking for. Intraday, you'd like to get at least a point or 2 points in a day or in a intraday few minutes to 10 minutes transaction. The reason you want to have point gains of this size is because that's where the real money is. Most retail traders are taught to trade and trade and trade until they have what I call traderitis. When you have traderitis, you are obsessed with trading. You have a compulsive behavior and a need to trade and trade often, and you tend to lose more money than you gain. You have some profitable trades, and then all of a sudden you have a whole stream of losing trades, so you actually attrition your capital and you're not making money. This happens to most retail traders because of the many different programs that are out there that make the trading systems, retail brokers, dealers, and others a lot of money from the retail trader trading too often. When you search and find stocks that are poised to move anywhere from 3 points to 8 points in a few days for swing trading, or 1 to 3 points within the day, within a few minutes to 30 minutes, then you make enough money that you don't have to trade hundreds of times a day or hundreds of times a week. Saying that you just want to pull 25 cents off or 50 cents is a very foolish notion. That is too small of amount of money to cover the risk that you are taking. When you're calculating your risk to reward ratio is what it's called, or what I like to call profit to risk ratio, you have to have at least a 3 to 1 to 4 to 1 ratio. That means you need to have 3 or 4 points potential point gain to 1 point loss of risk at your stop loss placement. Whenever you're swing trading or day trading, you must also use stop losses that are pretty darn tight. A lot of times, if you were to calculate the profit to risk ratio as I teach my students, you would find that you are trying to make 25-cent profit, but you're risking 3 whole points of loss. And that is why you don't make the money that you should be making. Most retail traders work very hard. They put a lot of time and energy. They're always on the internet searching for ways to make more money, trying to read this, trying to read that, trying to figure it out, going to hundreds of webinars a year, and still they don't make any money. One of the primary reasons is the profit to risk ratio. The profit to risk ratio is critical. And if you don't know how to calculate it and you don't know how to estimate what is your risk, your true risk, you can't use percentage stop losses. The HFTs and the pros know this, and they can tell when you have a stop loss in place. And if it's too tight, they will take you out. So you have to work with what the chart is telling you, the technical analysis, the chart analysis. The profit to risk ratio is built into the charts. And when you go to trade a stock, after you found a stock that looks like it's poised to move up or down or however you want it to move, the next thing you have to do is calculate your profit to risk ratio. Now, all my students have an advantage over you who are not my students. My students have the risk calculator, which comes with the course and automatically calculates the profit versus risk ratio. They also have the trade management planner, which helps guide them as to what price stock they should be using, what price bracket they should be using, the profit to risk ratio, and many other factors that tell them how many stocks they should be trading a day, week, month, what the price range they should have, the profit to risk ratio they must have, what the profit potential is going to be for the month, the share lot size they should be using, and much more information. When the students use the trade management planner, 90% of the work of figuring out whether your stock is going to make profit or not is done for you. The risk calculator is critical to the success of any student because it gives them the profit to risk ratio. Most traders, when I meet them and I talk to them and they show me what they're trading, the problem with their trades is very simple. It's not complicated. It's not a candlestick. It's not that they don't know Elliott wave. It's not that they don't know this. It's not that they're doing the wrong indicators. The primary reason that 90% of all retail traders lose money trading stocks on a consistent basis, rather than making profits on a consistent basis, is that they don't properly calculate the points profit versus the points at risk of loss. When you do this, you will find that you are picking stocks that are automatically going to cause you to lose money. When you start learning the TechniTrader way, you will find that you are making profits consistently because you are avoiding these pitfalls. A lot of the recommended stocks are already under heavy selling mode because those recommending the stock will sell while you are buying. And this is something that you can see on the stock charts and something you learn to avoid when you're a TechniTrader student. Momentum is required for a stock to be a good solid swing, momentum, day trade, or velocity trade. You must have acceleration of price and acceleration of volume. Now, what causes that? Because you can't understand what momentum is and where you should be looking for it in your stock charts if you don't know what causes momentum. We already know, as I've talked to you before in other radio shows, that a large chunk of the trades that fire off every day on the stock market of the U.S. are in hidden venues, the dark pool venues, the off the exchange transactions that don't show up on your charts during the day. If you are using real time, you are not getting all of the data. You're getting about 60 to 65% of all the trades that are firing off. So you're missing out on a whole bunch of data that you really need to have. The reason why stocks move with sudden momentum when they've been consolidating or compressing or whatever is because there is a large lot buyer or large lot buyers. They are quietly accumulating, or they are pro traders who are buying shares of stock and they're holding it at the penny price. And so there's this very, very tight formation that forms on our markets that was not very common 10 years ago. It wasn't common 5 years ago. It's becoming more common, and it's a new kind of pattern that you need to learn that is only taught at TechniTrader. When you see certain patterns, you will recognize based on the large lot indicators whether the large lots are on the buy side buying or if on the sell side selling. Because price is so tight and compacted, it is impossible to judge the direction the stock will take out of that consolidation or compression pattern merely by looking at candlesticks. You also have to incorporate large lot versus small lot indicators, which are not always used by retail traders because no one has taught them how to use them. I teach all of my students how to use accumulation distribution indicators, large lot versus small lot indicators, and so on, so that they can see who is creating the liquidity draw and on what side of the transaction are the large lots firing. For example, if a large lot institution or several large lot institutions and some pro traders on top of that are quietly buying a stock and they're keeping it at the penny spread or within a few pennies, volume may not show much, particularly on your charts, until after the market closes. And it takes about 60 minutes before all the data is gathered up and comes through the data providers to your software charting company and down into your software. You can't just use volume alone because nowadays not all the volume is being recorded real time on your chart. You also need large lot indicators which tell you where the institutions are buying or selling. When you know this, this not only tells you that the stock is going to move with momentum because there's this huge liquidity draw that is pulling shares of stock out of the market. They're buying and then they pause, and then they buy and then they pause, and then they buy and then they pause. That quiet accumulation is very hard to detect by retail systems. Retail systems are very basic, and although I'm sure you've been told they're great and wonderful and they're the magic cure-all for everything, and they will work in a moderately trending market, or they'll work to some extent in certain kinds of markets, but they'll fail dismally in others. You have to be able to tell where the liquidity draw is and on what side the transaction is occurring, because that will tell you that that stock is poised to move. Then you calculate where on the chart is this first level of resistance and whether that resistance is very weak, moderately strong, or very strong. When you know the strength of that, based on swing trading, there are certain kinds of resistance that a stock with momentum will push right through. It'll blast right through it. There are certain areas in the chart where when the dark pools are accumulating, they accumulate so many shares of stock that it causes the stock to push through and run with velocity, which is no overlapping of candles and no gap downs of candles in between each day's run. And velocity trading is very exciting because your gains can be massively huge. You're talking anywhere from 5 to 30 or 40 point gain in a very short period of time. When you have those kinds of gains, you don't have to trade all the time because you make very high profits on fewer trades. Fewer trades means less risk, higher profits, less money going into the pockets of your brokers, and more consistency, because you're only selecting the best of the best stocks with the highest degree of potential gain and not just trading anything that comes along because you're desperate to trade. The retail brokers, the retail trading systems, all of those companies that make money from you want you to trade too often. They want you to trade impulsively. They want you to trade so they can make money. You need to be aware of this because this is a reality that's never going to go away. When you can trade consistently, swing trading or day trading or momentum trading, whatever you want to do, it is because you have a set of rules and parameters which you adhere to all the time. You seek out the stocks that have greatest potential for the highest percentage gain with the smallest risk possible. This puts everything in your favor. This means that you have everything lined up to go with you. And it makes swing trading very, very lucrative. Swing trading's a blast. It's one of my favorite trading styles of all because it's exciting, it's fast, there's a lot of profit involved, and the setups are pretty easy to know when a stock is going to move with momentum. And this is what I teach my students because I like it and I enjoy swing trading. It also is fun for my students because they can see that it's not all that hard work. The trading systems will net you smaller amounts because the trading systems are set up to do so. And so you won't have that huge profit, and you will also be at risk constantly of having small losses. And then at the end of the month, you've traded maybe 20 or 100 or 150 times, and you find out that after you subtract all the fees and costs, after you deduct all your losses and everything else, you have made very little money or you've taken a loss. I have so many traders who come to me with this problem, And it's a simple thing that they just haven't completed all of their education. They don't have everything they need to actually be consistently successful. They've developed some skills. They have some trading habits. They have some idea of what they're doing. They have been trading for a while, but they still aren't successful. And that is why I teach, because I know that retail traders can make far more money if they just have the right education and fill in all the holes and gaps that are in their education. These things are not taught on webinars, they're not taught in internet website articles, because it is something that takes a little more detail and training, and the people who sell these things are not interested in making you consistently profitable. My students' success is my company's success. Because my students are so successful with their trading, so is my company, because we are strictly an educational company. We don't sell software. We don't sell brokerage systems. We are strictly education, so we focus on the education. Momentum trading requires that you first identify the liquidity draw of large lot traders or institutions. With the liquidity draw, at some point, there will be more buyers and not enough sellers. That will cause the price to move up. This is what HFTs like to do. They like to pull a lot of liquidity out ahead of the market open so that the market-making computers are forced to gap the stock up. And then the HFTs start selling quickly against those who are being filled by the retail brokers. So you get a very short change on your profits. You have to be in the stock before the big gap or run. To do that, you must understand the new compression patterns, the tighter consolidations, the penny spreads. You need to understand when and where pro traders buy and sell. How and when do they enter? What do their footprints look like? You have to understand the dark pools, their accumulation. Why are they accumulating? Where do they accumulate in the trend? And how does their buying affect the trend pattern and candlesticks? It's great that you've learned all the candlestick patterns in the candlestick books. I'm sure you've studied them fervently. But then I think you will also find that there's a bit of ambiguity and a lot of leeway in all of those candlesticks, because those candlesticks were for the Commodities Rice Exchange of the 1600s. That was not an automated market. There weren't giant dark pool institutions buying for investing. There weren't pro traders. There were a few commodity traders trading the rice exchange, which was considered a currency. So that's why a lot of times candlesticks work well for currencies, because that's what you're taught. But what I teach on candlesticks is totally different. I teach you the new candlestick entry and exit signals. I teach you the new candlestick momentum signals. I teach you what a velocity run is versus a momentum run. I teach you how to enter the stock before the stock is going to run with momentum or velocity in a huge gain. You don't need a lot of trades to make a lot of money. In fact, when you learn the TechniTrader way, you will be able to trade less often and make far more money. This leaves you time to go do other things that you would like to do that are fun. Momentum trading can be highly, highly lucrative. And when you know who is buying and who is selling and what side they are, and when you know that large lots are heavily invested or heavily selling the stock, it tells you what direction the stock is going to take. When you learn the profit-risk ratio that we teach, when you learn how to use the risk calculator that comes with our courses, and if you use a trade management planner as well, you will find that you are trading less often, making far more money than you did before, with far less time to make that money. It makes trading fun, it makes trading easy, and it simplifies it down to a mathematical equation that works. If you want to learn the things that only TechniTrader teaches, come visit our website at technitrader.com, and then you need to give us a call, and we can talk to you about what you're doing right now, what isn't working for you, what is working for you, what your goals are, and how you want to improve your trading. What you don't know will hurt you in the stock market. I'm Martha Stokes, and that's the radio show for this week.
There's so much emotionally charged hype out there designed to sell newspapers and advertising rather than inform investors and traders. Want entertainment? Buy a newspaper or magazine or turn on the news. Want investment and trading concepts explained? Look to TechnoTrader. TechnoTrader is the gold standard in trading and investing education taught by experienced and accredited professionals. Don't learn to trade from fad-chasing day traders, and certainly don't think you can grow your portfolio by attending a weekend seminar or watching a free video online. Success in the financial markets is attainable, but like any high-paying profession, it requires the proper education to achieve consistent success. Join those happy few who've taken their investing and trading seriously. Call 888-846-5577 or visit technotrader.com.